G'day guys, Tor here from Pro Stock Tips. Now, as you may have noticed, Facebook is down a whopping 21% pre-market, which is huge for one of the largest companies in the world, one of the US big cap tech stocks. This is quite a big pre-market drop for such a large company. It's wiping billions of dollars of valuation off Facebook, hundreds of billions even. So I think I'm going to buy this dip because I think it can it's certainly dropped off to a level where there was a previous sort of baseline for support. Obviously, it can break that, but I'm thinking this is a pretty hard drop, a pretty aggressive drop, and after such a large dip, you can sort of see a sharp bounce back. As we've seen in the past week or two with Netflix, we saw it dropped a bit more, and then it came back up above where it dropped to, because obviously that was quite an aggressive drop as well, in the pre-market. So similar deal with Facebook. We could certainly see the same thing as we saw with Netflix. We can certainly see potential to make 10% profit on the bounce, or we could hold even longer. Maybe it'll recover all those losses if we're lucky. And potentially it may even bottom out and rally to new all-time highs, or at least back to previous all-time highs over a longer term, a year or more. I can't, forecast this, but certainly the market is discounting Facebook's growth right now. Obviously, it's investors aren't happy that there was this slight earnings miss. Nothing too substantial. But basically, investors are fearful that Facebook's days of high growth, are in the past, and from now on, it's going to plateau and grow slowly. However, I think there's still a lot of growth for Facebook over the next few years. Facebook continuously reinvests its profits. It doesn't pay a dividend, keeps reinvesting its profits in growing its business, and obviously over the past few years we can see that it has increased its earnings quite significantly. Now, if we take a look at the 2018 highs, when Facebook's earnings were around $20 billion a year, they're now approaching $40 billion a year, which is almost double. However, we're only up about 20%. If we take this pre-market value, we're only up about 20% from the 2018 levels that I can see here on this chart from Google, right? So essentially, Facebook's lost a lot of its gains that it's made post-COVID, and it's only, say 17% above its pre-COVID levels. Now, is there still growth? Yeah, definitely. And I think that's pretty strong company still with Facebook and obviously Instagram, the two pinnacles of social media here. So it's certainly quite a good company. And in terms of earnings recoveries, well, I still see there's some potential here, because obviously there's still a lot of business lockdowns and that sort of thing due to COVID. So there's still been a lot of businesses that have been impacted by that. Global travel, is still out of the question in a lot of places. So I think there's certainly potential for the reopening trade, businesses coming back online, increasing their advertising revenue, travel opening up again, so increased travel, advertising potential there. Certainly a lot of pent up demand for travel, I imagine, after such a long time with no holidays. So I think that certainly there can be a lot of future earnings prospects in terms of advertising revenue for Facebook, and they can be reflected in future earnings, in which case, if we do see earnings growth start to re-emerge, then obviously Facebook stock can sort of initiate that rally as investors once again start to factor in earnings growth into their DCF models and all that sort of thing, right? So they may come up with higher valuations, and the stock price may indeed rally. Now, with the backdrop of interest rate rises, that's obviously been unsettling to investors lately. However, the interest rate rises may prove to be quite, slow. We're not talking about huge percentage rises here at this stage. So essentially, I still think that interest rates are relatively low compared to historic levels, and certainly the market sell-off from interest rate rises, or the anticipation thereof, might be perhaps too aggressive, especially if we look at inflation and will these interest rate rises keep up with inflation.